Today is March 19th, 2026, and right now, silver is doing something that I have not seen in my entire career as a metals analyst. The XAG USD spot price is sitting in the range of $72 to $82 per troy ounce. Let that number sink in for a second, $72 to $82. Because if you are watching this video and you do not understand what is happening in this market right now, you are not just missing a trade, you are missing what could be the single biggest directional move in silver of this entire quarter. I am going to say that again for the people in the back. This is not a normal silver pullback. This is not your run-of-the-mill 3% correction that shakes out weak hands. What is unfolding right now in the XAG USD chart is a violent, multi-layered confluence of macro forces, institutional positioning, and structural industrial demand, all colliding at the same exact moment. And if you do not have a roadmap, you will get destroyed by this volatility. So stay with me for the next 20 minutes. Because what I am about to break down for you, from the monthly macro structure all the way down to the 15-minute New York session entries, is going to give you a level of clarity that most retail traders never get. This is Silver Signals. My name is JIANG, and this is the analysis that matters today. Before we go anywhere else, let us talk about where we actually are on the map. Today, March 19th, 2026, the APMEX and USA Gold spot data is showing XAG USD in a range between $72.02 and $82.39 per troy ounce, with per gram pricing coming in between $2.32 and $2.57, and the kilo price ranging from roughly $2,215 to $2,140. Now those are wide ranges, and that spread itself, that enormous bid-ask volatility, tells you something critical about the psychology of this market right now. The spread is not that wide because nobody cares. The spread is that wide because everybody is fighting over direction. Buyers and sellers are at absolute war. To understand why this moment is so loaded with tension, we have to go back and place it in its proper historical context. Think about the last time silver printed numbers anywhere close to this, the war-driven spike cycles of 2022, the post-pandemic commodity surge, the squeeze events of early 2021, when retail traders attempted to corner the silver market, an XAG USD shot to nearly $30 before violently reversing. Now compare that to today. We are not sitting at $30. We are not sitting at $50. We are sitting at levels that would have seemed almost science fiction to most silver traders just 4 years ago. And the question every serious investor is asking right now is this the top, or is this a launching pad? Here is what makes 2026 fundamentally different from every prior silver spike in modern memory. In 2021, the bull thesis was largely speculative. It was retail enthusiasm, a Reddit narrative, and short squeeze mechanics. It was emotional, and it burned out. In 2022, the Ukraine conflict drove a flight to safety bid, but the moment geopolitical headlines softened, the silver rally faded just as quickly as it came. But what we are looking at today, this multi-month structural move that has carried XAG USD from the high 20s all the way into the 70s and 80s. This is not driven by Reddit. This is not driven by one war headline. This move is driven by 3 converging megatrends that are not going away, and I will get into each one of them in detail. But first, let me show you what this price action actually looks like on the charts, because the technical picture is just as compelling as the fundamental story. Let us start at the highest time frame, the monthly chart. Zoom all the way out. When you pull back to the monthly candles on XAG USD and look at the last 3 years of price history, what you see is unmistakably a higher high, higher low structure. Every major trough since 2023 has been a higher low. Every major peak has been a higher high. This is textbook macro bullish market structure. The monthly chart is not ambiguous. The macro trend is up. But here is the nuance. And this is where most analysts get it wrong. On the most recent monthly candle, silver has printed what technicians call a long upper wick. That means price pushed aggressively to the upside during the month, but then sellers stepped in with enough force to drag the close back below those highs. In candlestick language, that wick is a warning signal. It does not negate the overall bullish structure, but it tells you that the distribution zone, the area where institutional sellers are aggressively offloading inventory, is real, and it is active somewhere between the $80 and $90 handle. Keep that in mind. We will come back to it when we talk about the whale games at play here. Moving to the daily chart, the picture gets significantly more complex and more urgent. Over the last 2 to 3 weeks, what we have seen is a market that ran hard to the upside, printing daily candles that were genuinely explosive, the kind of candles that get featured on financial media, the kind that make Twitter trend. And then, without warning, the market printed single-day drops of $3 to $5 per ounce. In percentage terms, those are 3 to 6% single-session declines. In dollar terms, for a trader with meaningful position size, those are devastating. This is what Morningstar analysts have flagged as forced liquidation, speculative traders getting margin calls, being stopped out involuntarily, their positions being forcibly closed by their brokers, which creates cascading sell orders that have nothing to do with the fundamentals and everything to do with the mechanics of leveraged positions unwinding. On the daily chart, the critical support level that every serious trader is watching right now is in the $72 to $74 region. TradingView Community Analysis has flagged this zone as a major confluence. It represents a previous area of consolidation, a key Fibonacci retracement level, specifically the 0.618 fib, measured from the most recent swing low to the swing high, and a psychological round number support. The $70 area is where bulls are making their stand. As long as daily candles are closing above $72 on a sustained basis, the bullish macro structure remains intact. But if the market prints a decisive daily close below $72, especially if it is accompanied by high volume, that would constitute a genuine structural break. And the next significant support does not come in until the $64 to $66 zone, which is a long way down. Now let us talk about the 15-minute chart, because this is where the real money is made and lost in real time, and this is the chart that matters most if you are a New York session trader. During the New York Open, typically the 9:30 a.m. to 11:30 a.m. EST window, ZAG USD has been exhibiting a very specific pattern that I want you to burn into your trading brain. The market has been opening with a sweep. Price aggressively wicks below the overnight low, taking out the stops of traders who placed their stop losses just beneath the Asian or London session structure. And then it reverses hard. This is classic stop loss hunting at the New York Open. The whales, the institutional players, the big bank prop desks, they know exactly where retail traders park their stops. They have the order flow data, and they use that knowledge to manufacture liquidity. If you're entering silver trades during the New York session right now, you need to treat the first 15 to 30 minutes of the session as a manipulation window. Do not chase the opening move. Wait for the sweep. Wait for confirmation of the reversal, specifically a 15-minute candle close above the swept level, and then consider your entry. Your stop goes beneath the wick low. Your target is the next significant resistance, which on the current structure is the $78 to $79 area. That gives you a trade setup with a risk to reward ratio of at least 2.5 to 1, which is the minimum I personally accept for any silver trade in this kind of elevated volatility environment. Now, I want to pause here for a second and ask you a genuine question. If this analysis is already changing the way you're seeing this market, if you are looking at the XAG USD chart right now and you are seeing it differently than you were 20 minutes ago, drop a comment below. Tell me, what is your price target for silver by end of Q2 2026? Give me a number. $75, $85, $95, $110, or wherever you stand, I want to hear it. The comment section on Silver Signals is one of the most intelligent communities in the precious metals space, and I read every single comment. And while you are at it, if you're not yet subscribed to this channel, hit that subscribe button and ring the notification bell. Because the kind of analysis we just broke down on the multi-time frame structure, that is the kind of content I put out every single week, and you do not want to miss the next one. Let us now talk about the why behind all of this, because charts are a reflection of reality, and the reality driving silver in 2026 is unlike anything this market has ever priced in before. The first megatrend is the structural industrial deficit. Silver is not just a monetary metal anymore. It has not been just a monetary metal for years. But what has changed in 2026 is the scale of industrial consumption versus mine supply. The Silver Institute and multiple commodity research houses have projected that by 2026, silver demand from industrial applications alone will exceed global mine supply by somewhere between 150 and 200 million ounces per year. That is not a small imbalance. That is a structural deficit of historic proportions. And when you have a commodity where demand is structurally and persistently outrunning supply, over time, in any efficient market, price goes in one direction, up. The second megatrend is the AI and data center boom. This one catches people off guard because when they think about AI infrastructure, they think about semiconductors, they think about GPUs, they think about NVIDIA. But here is what most investors do not know. Every single server rack in an AI data center requires silver-based electrical contacts and connectors. Every PCB soldered with high-performance silver paste. The explosion in AI compute infrastructure in 2025 and 2026 has created a demand channel for silver in the electronics sector that simply did not exist at this scale 5 years ago. The build-out of hyperscale data centers across the United States, Europe, and Southeast Asia is consuming silver at a rate that analysts are still trying to fully quantify. And unlike speculative demand, which can evaporate overnight, industrial demand from AI infrastructure is a multi-decade consumption story. The third megatrend, and this is the one that arguably has the largest long-term supply impact, is solar energy and EV expansion. A standard solar panel contains approximately 20 grams of silver. Now multiply that by the number of solar installations planned globally through 2030. The International Energy Agency projects that solar capacity additions alone will consume a cumulative 8 to 10 billion ounces of silver over the next decade. That is not a forecast from a silver bug or a precious metals newsletter. That is mainstream energy research. Add to that the silver used in EV battery management systems, charging infrastructure, and power electronics, and you have a demand picture that is simply incompatible with current global mine production. Now, layer on top of all of this the macro monetary environment. The Federal Reserve has been navigating an extraordinarily difficult balancing act through late 2025 and into 2026. CPI data has been stubbornly sticky. Inflation has not cooperated with the Fed's desire to declare victory and pivot aggressively to rate cuts. The most recent CPI prints have shown core inflation holding above the Fed's 2% target, which means the real Fed funds rate, adjusted for inflation, has been compressing. And silver, like gold, is extraordinarily sensitive to changes in the real rate environment. When real rates fall, when the return on holding cash and bonds erodes in real terms, hard assets like silver become more attractive on a relative basis. The DXY, the US dollar index, is the other key variable here. A strong dollar is a headwind for dollar-denominated commodities. And right now, we are watching the DXY with significant attention, because any sustained weakness in the dollar will act as rocket fuel for XAG USD. Central banks around the world have also been increasingly active in the hard asset space. While the primary focus of central bank gold accumulation has dominated the headlines, with institutions from China to Poland to India continuing to add to their gold reserves, the ripple effect on silver sentiment has been meaningful. When central banks signal that they do not trust fiat currency systems and are diversifying into physical hard assets, retail and institutional investors read that signal and respond. It creates a reflexive feedback loop that amplifies the bullish thesis for the entire precious metals complex. Now, I need to give you the other side of this argument, because on silver signals, we do not just cheerleader. We give you the full picture, even when the full picture has some uncomfortable elements. The most significant risk facing silver bulls right now is the bull trap scenario. Here's how it plays out. Price rallies aggressively into the $80 to $85 zone, generating massive media coverage, pulling in FOMO buyers at the worst possible moment, and then, just when retail sentiment reaches maximum bullishness, the institutional players who have been building short positions above $80 trigger a coordinated cascade of selling. This is not conspiracy theory. This is how liquid commodity markets have worked for decades. The whales, the Goldman Sachs prop desks, the big London bullion banks, the commodity trading advisors managing hundreds of millions in AUM, they are not on your side. They're not trying to help you profit. They are trying to extract liquidity from you. The telltale signs of an imminent institutional liquidation hunt in silver are very specific. Watch for this. Price wicks above a major round number, say $80 or $85, in a low volume session, typically during the Asian session when liquidity is thin. That wick takes out the stops of short sellers above that level. Then, in the New York session, when volume returns, you see a massive selling candle that does not just give back the gains, it accelerates through the next support level. That is the whale playing the board. That is the market doing what it always does to retail traders who lack discipline and position sizing rules. The specific Fibonacci level I'm most concerned about as a potential bull trap trigger is the 1.618 extension of the 2021 to 2022 major swing, which projects to approximately $87 to $89. If silver tags that level with low volume and then starts to show lower highs on the 4-hour chart, that is a serious warning signal that you do not want to ignore. And if we see that simultaneously with a DXY bounce above the 105 level, the risk of a sharp $10 to $15 correction becomes very real. But here's the thing, and this is the nuance that separates serious silver analysts from the noise. Even a sharp correction does not necessarily negate the long-term bull case. Morningstar analysts have noted that even in the face of ongoing volatility and forced selling by speculative traders, underlying long-term interest in silver remains structurally intact. The smart money institutional buyers, the ones with 3 to 5 year investment horizons, are looking for these dips. They are waiting for the volatility to shake out the weak hands so that they can accumulate at better prices. A $10 to $15 correction from these levels would not be a sign that silver is broken. It would potentially be a once-in-a-quarter gift for anyone who has the conviction and the cash reserves to buy that dip with discipline. So where does all of this leave us? Let me give you my synthesis. The view from 30,000 feet pulling together the monthly macro structure, the daily volatility picture, the 15-minute entry mechanics, and the fundamental industrial story. Silver in 2026 is the most asymmetric trade setup I have seen in this market in the last decade. The structural deficit is real. The AI and solar demand is real. The monetary debasement thesis is real. The monthly chart confirms the macro uptrend. The daily chart shows us exactly where the critical battlegrounds are. $72 to $74 on the downside, $80 to $85 on the upside. And the 15-minute chart is screaming at us that the New York session is where the institutional games are being played most aggressively right now. For the long-term accumulator, the person who is building a physical silver position for a 5 to 10-year horizon, any pullback into the $70 to $74 range is a genuine opportunity. For the active trader working the XAG USD chart, patience, discipline, and a respect for the stop-loss hunting mechanics are absolutely non-negotiable. Do not chase candles. Wait for the sweep, wait for the confirmation, manage your size. Use Fibonacci levels as your roadmap. And always, respect the DXY correlation, because the dollar and silver are dancing together whether you acknowledge it or not. The next major catalyst window I'm watching for is the upcoming Fed communication cycle. Any dovish signal from the Fed, any hint that rate cuts are back on the table sooner than the market currently expects, will likely be a significant accelerant for both gold and silver. Conversely, any hawkish surprise that pushes the DXY sharply higher could be the trigger for the bull trap scenario I described. So keep your eyes on Fed speakers, keep your eyes on the CPI data flow, and keep your eyes on the DXY chart. Those three inputs will tell you more about where XAG-USD is going in the near term than any single technical indicator. Before I let you go, I want to make sure you are fully equipped for what comes next in this market. On Silver Signals, we are going to keep tracking every major development, every Fed statement, every CPI print, every solar panel installation record, every central bank gold purchase that sends ripple effects into the silver market. We are going to break down the charts every single week with the same level of detail and the same level of honesty that you got today. So if you have not subscribed yet, do it now. Hit that subscribe button. It takes 2 seconds, and it means you will never miss a Silver Signals analysis when this market makes its next big move. And drop your comment below right now. I want to know, what is your price target for XAG USD by end of Q2 in 2026? Is silver going to 90? Is it going to $100? Or do you think the institutional players are about to slam the trap shut and send us back to 65? There are no wrong answers, just real market opinions from real traders. That is what this community is built on. Give me your number, give me your conviction. I will see you in the next one. This is JIANG from Silver Signals. Signing off. Stay sharp, stay disciplined, and stay ahead.